Hey, it's Jim, and this is level 3 of the CFA program, a constructed response set on the portfolio management pathway and the learning module on trade strategy and execution. Let me just quickly remind you that way back in level 1, one of our goals was to identify mispriced securities. Of course, we were going to take the long position in undervalued securities and the short position in overvalued securities. What we're assuming here in this learning module is that we have done all of that work in the past and we're ready to execute the trade. So the question then becomes, and I'll go ahead and use another sports analogy, do we want to quickly jump into the market and execute the trade immediately and then jump back out? Or do we want to take our time and spread the orders throughout and among all different sorts of traders out there? So the sports analogy is, do we want to sprint and take advantage of all of those sprinting techniques? Or do we want to go ahead and run a marathon and go in and take our time and see what's going on and talk to lots and lots of different people? And my grandmother used to use the word putzing. She would say, Jimmy, you're putzing. So the question is, do we want to sprint or do we want to putz? Of course, sometimes sprinting is beneficial and sometimes putzing is beneficial. So if the CFA Institute uses that word putz on the exam, you'll know what they mean. All right, let's look at this essay here. We've got Blake Thompson, head trader, reviewing several trading situations on a volatile market day. So the Fed has done something and increased volatility, index up 2.5%, first hour of trading. So let's skip to 10 a.m., receive a call from Sarah, portfolio manager. She believes a particular firm, Cloudburst Technologies, has peaked, wants to sell 50,000 shares, which is 15% of the stock's average daily volume. Currently trading at 10 o'clock at 42, which is up from its opening price. But here's the key. Rodriguez suggests fair value is closer to $40. So the question then becomes, with all this volatility, do we want to sprint in this trade or do we want to putz? How about another trade by market logic? The decision price at 9:30 was $25. And you guys aren't old enough to remember this, but there was a show back in the 1960s called I Dream of Jeannie, where a genie would put her arms like this and she would blink and something would happen instantaneously. Now you should recall that those dudes, Harry Markowitz and William Sharpe and all those founding fathers of finance, they made some kind of an assumption that sounded like new information is instantaneously reflected into market prices. So that would be the I Dream of Jeannie thing. But we know, at least after looking at this learning module, that there is no genie out there executing those trades instantaneously. So there's some delay. So the order released at 15 minutes later, 25.20. There's the order size and the shares executed, average execution price. And there's some market stuff there and a beta and a closing price. So there's a commission of 2 cents per share. We also have to worry about this global fixed income fund. It needs to sell several large corporate bond positions to meet end of month redemptions. Now remember, when we're on the floor of the New York Stock Exchange or some other equity market, we need to worry about things like systematic risk and unsystematic risk. In the fixed income market, we typically don't use those terms. We're mostly worried. I mean, there are a lot of different risks there, but we're mostly worried about credit risk. We need to worry about, now note, these are pretty liquid investment grade issues. So our concern is, let's suppose we've got a bunch of BBB rated bonds. We're worried about those being downgraded to BB, which would move them from investment grade down to speculative grade by the end of the month. So we've got a similar kind of a worry. We'll use different terminology to describe it. And finally, we've got this algorithm, smart value weighted, claims to, notice what we have in bold, dynamically adjusting participation rates based on real-time price trends. So the first thing that should pop into your head is something like, all right, what did we learn all the way back in level 1? What do we know about individuals and groups of individuals who say they're really, really good at market timing, real-time price trends. So this may work, but we're going to have to overcome the obstacles of market timing. So clearly there's going to be some kind of a comment or a statement. So here it is. Let's see. This smart VWAP monitors price movements throughout the trading session, automatically increasing participation. Yep. All right. So I'm going to go ahead and say, I don't think I like this right off the bat. Benefits of traditional VWAP with real-time price adaptation. All right, here are the questions. Consider the following algorithms. All right, so a volume-weighted algorithm with 10% participation rate. And this is for the cloudburst. So let's go back to cloudburst here. Where was cloudburst? That was here, right? So we need to sell 50,000 shares. We're in the middle of this high volatility for this time period. 15% of average trading. We think the price is going to drop by, well, what is that? $2 or $3. Remember, this sounds an awful lot like something that we want to jump in and jump back out. No putzing on this one. Arrival price algorithm with aggressive execution profile. Boy, that sounds an awful lot like sprinting, doesn't it? A dark pool aggregator. Remember the dark pool, and there's a really cool question at the end of this learning module where we're asked to agree or disagree with some statements. And one is that if the dark pool, no trading execution and final prices are ever recorded, so that one's out. But there's anonymity. Did I say that word right? In these dark pools. Remember, the dark pools, they're kind of over there away from the exchanges, and so I always think of the dark pools as like the James Bond over there. Secret agent. We want to do stuff over there. We don't want lots and lots of people knowing what we're doing. Did I give away the correct answer there? Maybe I did. All right, so we'll have to calculate this market adjusted cost. That's relatively easy. That's going to be almost like a F over P minus 1 that I keep telling you guys about. All right, consider the approaches for the bond liquidation. So principal trade and the high touch agency trade. So remember, the difference between these two is entirely laid at the feet of who wants to take the risk. Does the portfolio manager want to take the risk? Do they want to take the risk with a broker? Or do we want to spread it out to lots and lots of brokers? So we'll figure that one out. And then let's talk about that comment that we made. There's question 4. All right, you ready? Back to question 1. So here we are, this cloudburst order. Which one of these do we like? I think I hinted at that one there. Yeah, so we want a sprint execution profile that is aggressive, so an optimal for urgency. And the learning module has a really great discussion about trying to capture alpha. And that's really, in the options market, we may call it decay over time. We might call it a delay on the floor of the New York Stock Exchange. We might call it the consequences of putzing. So we want to capture that alpha. Let me go back here. What was that for cloudburst? You mind if I go all the way back here? So remember, we've got lots and lots of trading volume today. We want to dump 50,000 shares. We don't want to putz and wait till it gets to down to $40 a share, or even less than $40 a share, right? Let's see, if we do that volume weighted, remember what that means is that we're just going to kind of putz throughout the day. We're going to say, okay, let's see what happens to volume. And that increases our exposure. 10% rate, that extends it unnecessarily. The dark pool, look down at the bottom, the order size, that doesn't justify any information leakage as the primary concern because we're over in the dark pool. We don't need to really worry about that. All right, let's go ahead and calculate this market adjusted cost. So all we're going to do, here, let me show you quickly here. We're going to go ahead and compare the arrival cost to what the index is doing, and then we're just going to take the difference between the two, and we're going to weight that by the beta. So this is what I said to you earlier. This is really just F over P minus 1. So take the average price, we'll call that future, and then the arrival price is the 2520. And then the side, this is going to be one for an individual trade. If we do a basket of them, there might be multiple sides there. And then you've got to multiply it by the 10,000 basis points. That's really just so that you move the decimal point over. So there you go, 99.21. And we do the same thing with the index, and we get 100, and then take the difference between the two. So don't forget this. I mean, it's super easy. Here, let me do this quickly. It's super easy for you to think, all right, let's do 99 minus 100. But remember that we're told in that table that the beta was 1.15, so you need to make sure that you adjust it so you get the minus number, so the trade performed better than expected. Now, what was I saying earlier? We want to figure out who wants to take the risk on this. So this is probably going to be that high touch agency trade, working with selected brokers over several days. Remember, this is the fixed income portion of that portfolio. What do we have to sell? You know, a whole bunch of bonds in there. So what we're going to try to do is we're going to try to putz. We're going to go out there and just talk to a lot of different people, minimizing the market impact. And what this does is that will eliminate, kind of the dumping out there. And so that's going to impact that market price. Why not the principal trade? Because of the risk. That's essentially going to widen those bid-ask spreads. And there are probably some other things in here. Dealers may price defensively. Yeah, that makes perfect sense as well. All right, here's that last statement there. Notice we have it right there in the evaluation. Does not improve the execution quality. What do we like about that? Traditional volume weighted. It aligns with the benchmarks. That makes perfect sense in there. Avoids prediction risk inherent in real-time price adjustments. What was I saying earlier? There's the market timing in there. Look at the conclusion. Disciplined approach outperforms market timing every single time, maybe almost every single time. That takes us through the end of this Blake Thompson. I want you to go to I believe there's 26 questions. Once again, this learning module, it's not 14 pages, it's almost 70 pages long. So we covered some good points in here, but if you cover those other 26 in there, I think you'll be able to do the breadth and depth of this learning module. So hey, thanks for watching. Have a great day. Good luck studying.